Then looking further down the road, we kind of are in a precarious situation because we have interest rates at essentially 0%. We have a very, very weak dollar. And all of this could, plus we have, a federal deficit that is enormous, unprecedented. So all of this could mean that we actually start worrying about inflation at that point. Right now, we're not worried about inflation at all in the near term. Right now, the worry is deflation. But as you move out and the economy starts recovering, then you could actually start seeing some inflation, and the Fed is going to have to move really quickly to head that off. And then probably by the end of 2011, you're going to stop seeing these extraordinary number of bank failures, the FDIC having to go in and take over a lot of banks right now. A lot of the banks are taking over smaller community banks that have a lot of commercial loans on their books that are non-performing, or they have construction and land development loans are the big problem for a lot of these smaller community banks right now. And then probably by that time you have a return to normal operation in the securities markets and the debt and the capital markets. And then once you get further out, 2012, then you have this big fiscal elephant in the room, which is that the federal debt as a share of GDP is going to be somewhere around 80%. And what do we do about that? We need to start addressing that sooner rather than later. But I mean, eventually once the economy turns around, it's going to be something will have already had to have been done, or some plan is going to be needed to start drawing that down. Okay, so now you should feel good because that's how everybody else feels. Now let's talk about here where things are not nearly as bad. If you look at just measured by the unemployment rate, and really when we get down to the local level, the labor market stuff is the best indicator we have of how the economy is doing. I mentioned that the unemployment rate both in Chester County and in the Philadelphia Metro Division, which Chester County is one of the counties in that division, is at the highest point that it's been since about 1982, but it's still much, much lower than nationally. Chester County, the unemployment rate right now is about 6.5%, compared with the national average of about 10.2%. So we're not seeing the same magnitude of job loss or unemployment that we're seeing nationally. And then the housing market is also a comparatively bright spot. This is looking at how far single-family homes have fallen since 2006 Q1, which is the peak for most areas, the peak in national house prices. Nationally, they've fallen more than a third. It's about 33% right now since that peak. But here in Philadelphia and actually in Pennsylvania, they've fallen by less than 5%. And as I mentioned, there wasn't nearly as much speculation in the market. There was not a lot of subprime borrowing at all around here, and you didn't have big oversupplies of housing. So house prices have, comparatively speaking, held up fairly well. And then if we look at the actual jobs picture, it's not pretty, and it's not pretty here. We've lost probably about 4.5% of all the jobs since the peak. The peak in employment, this is according to the BLS's household survey, was early 2008, probably in the first quarter of 2008 in Chester County. And since then, we've lost about 4.5% off of that peak. Nationally, it's much higher. It's close to 6%. And I also wanted to throw in here, the blue bars is what I'm talking about here. So this is the current cycle. From the peak of the current cycle to right now, we've lost 4.5%. And I have these sorted in ascending order. So actually, of the 5 counties in the Philadelphia Metropolitan Division, Chester County has the lowest job loss of all. The biggest job loss is Delaware County. So as you go from left to right, job losses increase. And I also wanted to just give you a sort of a decade-long perspective too. The green bar is the change in employment from January 2000. So right before the peak of even the last recession, 2 recessions ago. Employment in Chester County is still up almost 10% from then, which is remarkable. I mean, if you look at the comparison to other areas, Montgomery and Bucks County employment is up compared to then, but they've lost almost all of those jobs that they gained over that period. It's barely positive. Philadelphia and Delaware County, they've lost all the jobs that they gained since then. So employment now is actually lower than it was at the start of the decade. So we're still in a very good spot comparatively. And as I've mentioned before, a lot of it is the composition of the economy, education and healthcare, which haven't been as resilient during this recession as they have during past recessions, but are much less cyclical than financial services, information, some professional business services, so we've held up relatively well. And I do attribute a lot of it to the fact that we have a much healthier housing market here. We didn't suffer the same magnitude, the same loss of wealth that was lost elsewhere just in terms of housing wealth. So you didn't have the huge drop in consumer spending here that you would get in other parts of the country where, in some cases, housing wealth has been completely wiped out, if not nearly wiped out. We think that we look at every month, we do a little exercise where we calculate the recession status of the whole country, so all the states, all the metro areas. So we think that we're still in recession. So unlike the US, which is probably technically in recovery, we're still in recession here. But it's certainly moderating, and you can see that losses, job losses, the increase in the unemployment rate recently has gotten much more modest. So it looks like things are improving, and we expect that this area, it tends to follow the national economy pretty closely actually in terms of the timing going into and coming out of recessions. So probably in the first half of next year, second quarter, we'll start to see positive job growth here again as well.